Hello, everyone. Welcome to our Andersen Tax 101 webinar. Today, Philip May, and my colleague Paula Owen will be presenting the Canadian Trust Reporting Requirement. There was some new development that is coming into effect for tax year ending December 31st, 2023. So before we jump into the webinar, we're going over some of the participation items. And our webinar are now registered with the National Association of State Board of Accountancy, that allowing our audience to get continuing professional education credit by simply watching our webinar for at least 50 minutes and answer all the polling questions. Once the webinar is finished, our team would issue the certificate to all qualifying attendees. Also, during the webinar, feel free to ask any questions. We would have panelists that answering some of those questions, and also brought some of the question to our answer at the end of the webinar. Also, after the webinar, we would send out a quick survey asking how you feel about our webinar, and then some of the items or topics that you will want us to cover in the future webinar. Last but not least, that this webinar have the live transcript function. Please click the CC button on the bottom of your screen to turn it on. Moving to today's agenda, we will first touch on some of the previous tax rules for the trust, which is the rules that have been applicable before tax year 2023. And then Paula would give us some overview of what has been the change to the new items for the new trust reporting rules, some of the expanded reporting requirements. I will discuss one of the key items for the expanded reporting requirement, that is spare trust. And then Paula would also go over the penalty applicable, and then I will finish up with some tips and reminders to our audience. First, this is the previous tax rules that are applicable to most express trusts. A trust only required to file a trust tax return when it has earned income, disposed of capital property, or distributed income or capital to beneficiaries. As you can see, that it only applied to certain express trusts. Some of the trust that does not fit any of the three requirements would not have to file any trust tax return on an annual basis. And then trust tax return is also required for a deemed resident trust. That is a trust that is not a factual resident of Canada, but deemed under the Income Tax Act to be a deemed resident of Canada. If a trust is required to file a trust tax return, the trust tax return is going to be due 90 days after the tax year. And for most trusts other than graduated rate estate trusts, is required to have a December 31st year end. So for a typical year, the trust return will be filed by March 31st of the next year. But given that 2024 is a leap year and also March 30th happened on a Saturday, the current 2023 trust return would be due on April 2nd of this year.
You also get the benefit of Easter Monday.
So yeah, so in case any tax deadline fall on a weekend or any statute holiday, it would be due on the next business day. So this is the current and trust rules. It's a lot of our tax practitioner or audience that got impacted should already be pretty familiar with it. Now Paula gonna give us some of the background of the new reporting rules.
Yeah, so these rules were actually supposed to apply to tax year ends for December 31st, 2021. It's been deferred twice now. So it was supposed to again apply for tax years December 31st, 2022, and was again deferred. We didn't get so lucky this year. These will come into effect for any trusts that have a December 31st, 2023 tax return. It was part of the 2018 federal budget, actually. And like I said, it was supposed to be applied for the 2021 tax year.
So Paula, it seems like the government is trying to expand their informational disclosure, asking all the taxpayer to disclose a lot more information than usual.
Yes, we'll talk about more of those reporting requirements as we get into the presentation. But I think the deferral of applying the rules is because of that very fact. There's a lot of disclosure, a lot of information that's going to be required when filing these trust returns. And I think CRA had to delay applying the rules just to let everybody get caught up, get familiar, and know what is required.
So Paula, it sounds like a lot of government, or when the new tax law got implemented, that when they draft the law, they have no idea how expensive the reporting would be. So they just keep referring it and ironing out some of the details.
I think so. Yeah, it's going to hit a lot more people than before, for sure. Okay, so there's three changes to the trust reporting rules, really. So now all trusts have to file a tax return, regardless if they have earned income or not. Bear trusts are also included in the rule, and that's a really big change, actually. And Philip will talk more about bear trusts as we continue on the presentation. In addition, there is going to be a lot of disclosure required with the trust returns in regards to the beneficial ownership. And I think this is the real basis or why CRA is implementing these new rules. They're really wanting to find out who actually owns what and is trying to use the trust returns as an avenue to do that. So now, maybe you had a family trust that held shares of a company that's just sitting there. It's not earning income, or maybe it's a family cottage, etc. In the past, that trust would not have had a filing requirement. This year, it does, and there's, like I said, there's a lot more disclosure that's going to come into play as well.
So I think Paula, as a tax professionals, I think we are not certain on how CRA is going to use those information yet. I think eventually there may be a trend that CRA may come up with some initiative of how to cross referencing the different information that got disclosed on different various forms. In the end, with Paula's example, that if maybe one of the corporation is also being a beneficiary of the trust, then it could be associated with other company that was not necessarily disclosed on a corporate tax returns. So maybe when CRA have the technology and the manpower to process those information, they could cross-reference and issue more notice or review assessment to those impacted entities.
Right. Associated and connected companies share the small business rate, and there's other disclosure that you have to do on the corporate returns with associated companies, and this could be a way of them gathering more information to determine that.
Yeah.
So now we're at our first polling question. The question is a Canadian trust required to file a tax return when it has no income under the old rules? I'll just give you a little bit of time here to answer that question. And hopefully it's not too much of a trick question there. Okay, do you think that's good, Philip? Or
yeah, I think that's probably good enough time.
Yeah.
So the quick answer would be no, but obviously we realized that we didn't provide all the details. I think we have the assumption that if the trust have no income and no other distribution, then it's not required under the old rules. But if the trust that does not have any income but distributed capital property to the beneficiary, then become yes. So this is kind of a tricky, it's not decided particularly well. We just further demonstrated that, hey, under the old rule, it's not required if you don't have any transaction going on, but under the new rule, depending on whether it fits any of the exception, now you might require to file the trust tax, a kind of a trust tax return on an annual basis.
Right. And, for some trusts that are set up, now they have a compliance fee on an annual basis that they didn't have before, for example. So it is something to consider. I think people are going to have to take a look at what they've set up and why, and just make sure it still makes sense to keep their structures in place. So we really wanted to dive into the expanded reporting requirements that CRA is now asking on the trust return. So you're required to report on all entities that are part of the trust. So it'll include the trustees, the beneficiaries, and the settlers. Any person that has the ability to exert control will have to have more disclosure in these returns. And that's a lot of people that can be included in that for some trusts. For example, a family trust, it's good practice to set up these trusts with contingent beneficiaries. So you might have a first line of people that you're wanting your estate to go to. If something were to happen to those beneficiaries, you would cite additional beneficiaries in your trust documentation to make sure that your assets are going to the people that you want it to. So now it's going to be the trustee's responsibility. It is the trustee's responsibility to file the tax returns in regards to the trust. And it's going to be their responsibility to report this information for all these people, which may not be very easy to do.
Yeah, like Paula said, there's onerous kind of burden on the trustee to collect those information. The new rule also expands some of the definition of the different reportable entities. For example, settlers. The common understanding for the settler is the person that originally contributed to the asset to the trust when the trust is set it up. Practical matters that typically when a family trust or a trust setup, the settler is someone that is usually a friend or non-related to the individual that is typically contributing most of the funds. What they typically do is they could probably buy a gold coin, put that into a trust, and after that, they have no dealings with the trust or trustee or the beneficiary at all. So under the new expanded reporting requirement, that particular settler would be required to be disclosed. And also the definition of settler now include anybody that has been making a loan or making a contribution to the trust, unless that party is dealing with the trust at arm's length party. Going back to my example of a family trust, let's say that I want to set up for a family trust for my kids. I would ask Paula, saying, Paula, can you help me to set up the trust being a settler, putting one gold coin? And then after that, Paula would walk away. I would contributing my wealth into the trust. And then I would appoint maybe a third party being the trustee. And also as a good practice, I would want to include as many people as I want or I can as the beneficiary. Maybe my children's, my parents, my grandparents, my cousins, my nephews, my siblings, and maybe even my friends, just in case. Give me some flexibility in terms of how I want to distribute the asset. And also in case some disaster happened, in case, say, my children may predecease me, then at least I still could distribute the asset to my cousins. So right now, all of those parties that I have mentioned, they become the reportable entities. So as you can imagine, whoever acting as the trustee for my trust would have a lot of information to be collected, and then report that to CRA on an annual basis. And also that kind of exercise should be done on an annual basis, because you never know, maybe my cousin is giving birth to another baby, and then now I have one extra nephews. So as you can imagine, there's a lot of work, and some of those cousins I may never talk to, like for the last 15, 20 years. So that become a kind of a lot of administrative burden on the trustee's perspective.
There's also a bit of a privacy issue here too. Some people set up trusts and don't necessarily want the beneficiaries to know that they're part of their estate. So now on the next slide, actually, we'll talk about what exact information you need to report. But you will have to ask them for that information most likely So this is going to cause some further issues as well, I think, for some people.
Yeah, I get that sensitive feeling that when I asked my
Right.
nephew about being a, and then that's likely the first time they know that they are named as a beneficiary of my trust, but likely they're not getting any of the distribution.
Right.
You could imagine how much family dynamic it could change when
Yeah.
you're aware that you are named as the contingent beneficiary of 15 different trusts, but when they all pass away, you're not getting a dime or a penny of them.
Yeah, exactly.
So Paula gonna give us a little bit more information of what the information CRA looking for from the trustee.
Yep. So they are only going to accept this on their Schedule 15. They will not accept an Excel document or Word document, etc. You do have to populate this on their provided form. You're going to have to provide the name, type of entity, their address, date of birth, and country of residence, and their taxpayer identification number. Of course, for Canadians, that's their social insurance number. So again, a lot of personal information. Some people don't like providing others with their social insurance number. And for example, determining somebody's residence, it's a complicated topic, as you and I know, Philip. That's not always easy to determine. So if there's some uncertainty there, you're going to want to give yourself time again to obtain this information, populate it, organize it, and for a trust that has one beneficiary, no problem. But for the example, like Philip displayed there, with a family trust that can have a lot of beneficiaries, contingent beneficiaries, etc., this could be quite the onerous task. And it's January 16th. These returns are due on April 2nd this year. So time's ticking quickly.
Yeah, and also like Paula pointed out that we keep emphasizing that how much information CRA has been asking for. And we also imagine that in practice, in real life, that a lot of the beneficiary or a lot of the reportable entity would have some resistance of disclosing such information, especially for a trust they are not likely getting any benefit from. And also Paula mentioned about the country of residency. That's kind of for a tax purpose. So that's slightly different than where you live. A lot of time that, especially given after the pandemic, people are moving around way more often. It is extensive practice or kind of analysis to be done to determine the tax residency of any particular taxpayer. And then the next kind of administrative burden I could see is the taxpayer identification number. For someone that is not born in Canada and do not have a social insurance number to begin with, they would have to go through a process to get a Canadian individual taxpayer numbers. That it would be another professional fee that they have incurred, and also time that have to be spent.
That's right. Yeah, I agree.
So now we know what information have been disclosed and then who will be reportable. Then we're going to move into the next new bigger topic, that a bare trust. As we have mentioned earlier, that after the new reporting rule, the expanded reporting requirement, bare trust is also required to be disclosed on an annual basis. So bare trust, this term may not be as familiar to our audience comparing to just a typical trust. It was actually not defined in the Income Tax Act, in contrast to the regular express trust. For a bare trust, the trustee is just acting as an agent for the beneficiary. That's just the agency relationship. So, and under the bare trust, the trustee really have no obligation, no powers. So this is the big difference comparing to the bare trustee versus the trustee of an express trust. Because if for a typical trust that was drafted, the trustee does have an obligation and power for the benefit of the beneficiary as outlined in the trust agreement. So they are obligated to follow the trust agreement, and they have certain power to manage the trust property without any consents from the beneficiary. So they are kind of free to decide what is the best best action to be taken on regarding trust property when to make certain distribution to the beneficiary. So as you can see, the bare trustee here really do not have any obligation or power. They barely acting as an agent. In a bare trust settings, beneficiaries still remain having the complete control of any of the property inside of the bare trust. So you could think about it as a bare trustee basically is the one that holding the legal title of the property, showing up as the title owner, but really doesn't contribute any of the asset to purchase the property, or doesn't maintain any control, doesn't enjoy any of the economical benefit of the properties. Because of that, bare trust is usually disregarded for most of the Income Tax Act. So for example, that if we have a bare trust, let's say for a real property, any of the income from the real property, either rental or capital gain from the rental property, will be kind of reportable 100% by the beneficiary. The trustee does not even have to disclose anything on his or her kind of individual tax return. They have there's no requirement to pick up anything. And then I guess after the enrollment or the new trust reporting rules, now bare trust is kind of become a thing for the tax return filing purpose. Then we are going over some of the examples that where bare trust is commonly used. I have already kind of teased on the first one that a bare trust could be set up to be a title holder for real property for different reasons. For privacy, imagine that there was certain celebrities or you are well-known locally, you don't want everybody to run the land title registry to find out which property you actually own. You could set up a number company being the title holder while you being the beneficial owner. So, and also a bare trust is commonly used when doing real estate transactions. So you don't necessarily want the buyer to know who you don't necessarily want the seller to know who the buyer is. So you set up a kind of empty shell company being the title holders. So you could get a bid, submit an offer to the real properties. So that's one of the common use of real property. And then the other one is minimizing land transfer tax or probates. So in a lot of different provinces in Canada, at the provincial level, they charge land transfer tax when the title of a real property was transferred from one party to another. Then a bare trust could be set up to be the title holder when only the economical interest is being transferred. So title-wise, it remains the same, but it's just the beneficial ownership change. So that's how they kind of minimizing the land transfer tax. The same applied to probate. Various provinces in Canada does have probate when a taxpayer passes away. So the probate tax or probate fee would be charged based on the gross value of the estates. There was some planning regarding probate by adding your children or your grandchildren to your title. So upon the death of the original owner of the real property, the ownership of the real property would be just passed to the joint owner under the joint owner with right of survivorship. So it's kind of a sidetrack to got transferred to the joint owner without being subject to probate. Depending on the province the taxpayer resides in, the probate fee could be significant. So it's a pretty common practice for probate fee plannings. But from now on, you would have to ask more questions regarding whether the joint owner really just staying on title, or is there actually a gift that was made to the joint owner. So there are a lot more questions to be considered. The next one that we see quite often is facilitating property transfer in a reorganization. So in a corporate reorganization, there was multiple, there usually a lot of transfer for real property from one legal entity to another legal entity. for the same reason of trying to minimizing land transfer tax or make sure that you avoid all the paperwork related to title transfer. You could nominate a bare trustee owning the legal title and only transfer the economical interest. So the next one is gift to minors who cannot hold titles. So a lot of times that the grandparents may want to give cash or money to their grandkids when they are young. They might not allow to open a bank account yet. I think depending on the age, certain bank would allow you to open an account at age under 18. But let's say that if they are just really just born, a lot of time that the parent or the grandparent would set up an interest account. So once they set up the interest account, the money still belongs to the minors. But the trust, the parent and the grandparent in this case just owns the title of those assets on behalf of the grandkid and the children. So this one is probably applicable to most regular people that does not necessarily care about privacy and not necessarily into a lot of transactions, which is pretty common for a lot of regular folks that they would have interest account. And to your surprise or not, like this would be also considered as a bare trust because wherever the account holder is holding the money on behalf of the minors, and they really don't have any beneficial interest in the money inside of those accounts. So under the new rules, a trust return would be required to be filed on an annual basis. So
I think this one is going to catch a lot of people, isn't it, Philip?
oh yeah, it would be catch a lot of people, and it would be a lot of surprise. A lot of times you don't even know. Sometimes the bank would identify that the account would be in trust for. Realistically, that's not the only determining factors. So let's say that I have a kid at 5 years old, grandparents give them some money, then I could just open an account with my name on it. I know this money belongs to my kid, but it doesn't show up on the statement. It's up to you to determine that it's really a bare trust.
Yeah, exactly.
And then the last one is just also similar to the first three, that hold title of certain property on behalf of the group of owner and one joint venture or partnership. Joint venture and partnership, if they're into kind of real estate, is usually practical to have both entity. Like a joint venture, you have multiple entities involved. It's tough to separate the title into different title owners. So you will set up nominated a bare trustee to hold a title on behalf of the joint venture. So those are the five kind of really common examples of bare trust. As you can see that there was common theme that the bare trustee mostly owning the title of property or being shown as the account owner, while the beneficial interest of those underlying assets still belong to another party. And a lot of the time in real life that what we notice is a bare trust, usually there was not written agreement related to it, depending on whether you're dealing with a business transaction or mostly private. I think the fourth example of gift to minors, that typically nobody is going to draft a trust agreement for setting up an interest account for their kids. Right. So there were a lot of things that a lot of the kind of the real life example would be caught by the bare trust. So we talk a lot about the bare trust and expanded disclosure requirement. So now we moving to the second polling question. So after we talk about all of this, who are responsible for filing the trust tax returns? A, trustee; B, beneficiaries; C, the settlers; D, all of the above. So remember, this is the filing of the trust returns. That's the kind of the key. Right.
I liked your example of the real property. I always think of the celebrity unit and the land titles. That's a great example of the bare trust, which is, I'm sure, used a lot in that industry.
Yeah, I think when you are at certain status,
Even other people with a certain status, exactly.
So most of our audience actually get the question right, that the trustee is responsible for filing the trust tax returns. In the rare cases that the trustee, beneficiary, or settler happen to be the same person, and obviously that person is still responsible for filing the trust return, but the obligation coming from being the trustee of the trust. So we talk about all the new requirements, all the expanded reporting requirements. So does CRA give us any of the leeway, provide us any exception? That's what we're going to talk about next. So certain trusts still going to be exempted from the new filing requirements. The first one is listed trusts do not have to file. Listed trusts usually including mutual fund trusts, segregated fund trusts, trusts governed by registered plan, deferred sharing plan, some sort of retirement plan, and then lawyers' general trust account. So lawyer typically hold the funds from any real estate transaction in trust for their party. That in trust account is exempted from the new trust filing requirements. And then graduated rate estate, which is the estate that designated by the executor of a deceased taxpayer within a year after the taxpayer passed away, is allowed that the estate remain as a graduated rate estate for up to 3 years. That would be exempted from the new filing requirements. And certain qualified disability trusts, and any trust that qualify for a non-profit organization or charitable registered charities. So those listed trusts always don't have to file a trust return. Even under the new rule, they still don't need to file the trust return. I guess except the graduated rate estate that they would require to file a trust return, but not subject to the expanded requirements.
Yeah.
The next point is for basically any new trust. So if the trust has been exist for less than 3 months at the end of the year, of the tax year, is not going to be required to file a trust returns. But obviously, for the next tax year, that particular trust will be obligated to file any trust returns. The next one is for any express trust that have asset with a total fair market value that is less than $50,000. The asset only include cash and marketable security. And the $50,000 threshold is applied to any day throughout the tax years. So if you have one day that the market value of the security go up to $50,000 and $1, the exception is kind of out of the way. So that's one of the reasons that if the taxpayer or the want to rely on this particular exception, they have to really keep close attention to the value of the asset held in the trust. So that's kind of the exception that we have mentioned. It does not, the exception is kind of pretty narrow in my mind because the listed trusts always don't have to file a trust return. You always get the exception. The real exception in this case is only any new trust that has been set up in the year, or any trust have minimal amount of asset that is less than $50,000, which is pretty easy to get over if you're considering even cash account. 50,000 nowadays doesn't give you a lot in the new days.
And it's pretty limited if it's only considering cash and public securities.
Yep. So
any shares in private companies, you're offside. Real property, you're offside. Mm-hmm.
So Paula is going to talk a little bit on the administrative side that what if now you identify certain trusts now have to file any trust tax return?
Yeah, so if you never filed a trust return before, you probably don't have a trust account number. And that's the first step, really. So you need to apply for a trust account number using CRA's form T3APP. The best way to do this is through the online account portal. You'll receive it immediately. And we've just, in our practice, especially with over the last few years, doing anything online with CRA, it's the process is really expedited. So as a trustee, you're able to register yourself as a designated person to review the online account and access it. You can also allow your accountant to have access to your online account, but that is the fastest way to receive the number, and you'll receive it immediately. You do have to provide some information to get that trust account number. So the trust type, the name of the trust, trustee information, and some supporting documentation. The supporting documentation would be the signed trust, if you have that. Or if you don't, then CRA has said that you can provide a written summary of the trust with the date that it was created, the names of the trustees, and the names of the settlor and beneficiary. So that's probably what you're going to have to use for some of those bare trust arrangements, such as the in-trust accounts that you have set up for the minor children or maybe a relative, etc. Of course, you're not going to have a trust agreement for those. So you will have to provide a written summary of what that account is called. Even the trust name, there is some guidance on the CRA website of what to call it. It's generally the person's name with in trust after. But they have provided some good guidelines online now of how to apply for that account number. And that would be your first step.
Thanks, Paula. So as you mentioned that applying through the My Account portal would be the most efficient way. What if the trustee is more elderly, that they're not good with the computer skill? Like what if they want to apply it through paper application? I would assume that it's going to take a long process for them to be able to assign a trust number.
It could. You can mail it, or I believe that there's an ability to fax that as well. No, faxing just sounds old. But you can call CRA as well and work with them to apply for the number in that instance.
Good.
Yeah.
So we talk a lot about all the different requirements, what is reportable. So what if someone that does not follow the rules? I guess Paula gonna tell us all the penalties related to it.
Yes, and there has been some changes under the penalties as well. So of course, like all other tax returns, personal, corporate, etc., there's late filing penalties that apply. So that hasn't changed with the trust returns. So there's a penalty of $25 that each day it is late, a minimum penalty of $100, and a maximum of $2,500. The change to the penalties is in regards to this gross negligence penalty. So this is when a trustee just decides, no, I don't want to provide all that information. I know I'm aware of it. I know I'm supposed to, but I'm not going to file a tax return, or maybe I'm not going to complete Schedule 15 and provide CRA with all the additional reporting requirements. If that comes to play, then CRA can assess a maximum penalty a minimum penalty of $2,500 and a maximum of 5% of the fair market value of the property in the trust. And as you can appreciate, that can get quite high. And let's think about that family cottage again. Some of those family cottages are worth millions of dollars. So the penalty on that would not be good. So again, there is an exception for the 2023 tax year, and that relates to the bare trust. I think CRA has appreciated that including bare trust in this filing requirement is new and quite onerous on a lot of people, because it does encompass a lot of arrangements that didn't fall into this category before. So for the 2023 tax year, bare trusts, this penalty is waived unless they do know it's gross negligence, then it will still apply. So you can file late if you're having trouble gathering the information, but you're making an effort to, you're doing your best, then the penalty wouldn't apply in that case. So this is a big one.
So Paula, going back to the example that I brought up before regarding my own family trust. So what if the trustee, let's say my brother being my trustee, and then he knows that it has to be required to file and disclose all the information, but he's probably in a bad relationship with our cousins and doesn't want to disclose it or doesn't want to make the phone call to ask for the information. Is he going to be subject to the gross negligence penalty?
Well, the trustee isn't personally responsible. It would be a penalty that is assessed against the trust. But that, yeah, that's a family dynamic that is not a good situation at all. So you don't want that estate to, a part of the estate to go to CRA due to a penalty. So you'd want to protect the estate as much as you can.
So I guess because my brother doesn't want to call my cousin, now I basically my net worth is gonna subject the penalty. So
Correct.
I guess that's not so good. Maybe I have to make the call then.
Yeah. No, this is a big change. It's not often that CRA assesses a penalty on a fair market value of a property. So this could be quite significant for people.
So I think now we're getting into polling question number 3.
Yes. So polling question number 3. Does a trust holding $10,000 in cash and settled with a gold coin need to file it under the new rules? Yes or no?
This is a little bit tricky.
It is. And it's going to affect a lot of people as well, I think.
Oh, so this.
It was a tricky question.
Yeah.
So the answer is actually yes. A gold coin is not considered cash in this circumstances under the exception for the $50,000. So a lot of trusts are settled in the past anyways with a gold coin or a silver coin. This will probably be changed for some trusts that are coming into effect in the future, or might be something that people want to think about. You settle it with a $5 bill, I guess, or something that is not a gold coin if you know the assets are going to remain under $50,000, because then you will not have the annual trust filing requirement.
Good catch, Paula. So I think I'm sharing some personal experience too that a lot of the law firm, they would actually order a lot of gold coin in the office so they could sell it to the settlers, and then the settler could contribute the gold coin back to the trust that as a common practice. And then like I discussed earlier that usually that's all the settler have to do. They just have to put in one gold coin and they walk away. And then whoever want to set up the trust, we make any contribution to the trust, and then the trustee gonna run with the property. But now, as you can see, that some of the old practice now would create unnecessary reporting burden, and also basically make it not meet the exceptions. So I think, like Paul has suggested, that maybe in the future, the law firm may have to just get a stack of cash that they're all keeping the serial number instead of getting the gold coins.
Yes, because now there's going to be an annual cost to maintaining these trusts for the compliance fees that most people are going to have to pay to get the trust returns prepared if they're using an accountant to do so.
And Paula only mentioned about new trusts. So for all existing trusts that already been settled with a gold coin, unfortunately, you could not rely on the $50,000 exception ever, because usually any property settled with the trust cannot be withdrawn until the whole trust got collapsed.
Right.
So let's moving on some of the tips and reminder. I know we talk a lot about the new expanded reporting requirement, and talk about how important it is, how expensive it could becomes. Here are some of the tips to either taxpayer that thinking about setting up trust or already having trust, or practitioner that helping their client, advising their client how to deal with trust. I think the first tip is go through your financial histories and identify all the trust that you might have, that you being one of the reportable entity. Sometimes You could happen to be a beneficiary of your parents' trust, your grandparents' trust. Since you're more educated, you could potentially more educated comparing to them. Hopefully you could say that after attending our webinar today, that I guess acting as your own interest, you should let them know about, hey, now we know about the new reporting requirement for the trust. The trustee have to do something. If the trustee doesn't do anything, it's the trust that got suffered, right? All the penalty is going to pay with trust asset. So even as a beneficiary or as a settler that maybe your friend asked your help like long time ago, you maybe just kind of sharing that message saying that, hey, are you aware of the trust now is required to file a new trust tax return and all the information have to be reported. That's mostly related to express trust. I think that the tougher one to identify is any bare trust. You want to review or maybe ask if you happen to be entitled of your parents' house, or if your grandparents or you yourself setting up any in-trust account for the kids, or even whether you're holding any cash or asset on behalf of any of the minors that really the beneficial or the economical owner of those assets. That basically constructed a bare trust. So going through that review process, identify any trust that you could think of. That's kind of the first step. The next one is identify all the relevant parties. We discussed it multiple times. Now the reportable entity, including settler, which the original person that contributed asset to the trust, anyone that making a loan contributed asset to the trust, any beneficiary. Now you have to identify every individual in a class of beneficiary. Common practice is you could identify that maybe issue of your children to be the beneficiary. Now you have to identify any children that give birth to your children. So basically your grandchildren, and then you have to keep reviewing it on an annual basis. So in case someone died, someone was born in the year, that you have to keep updating that list. The next one is always the communication. In the case of you being one of the reportable entity of any trust, communicate it to the right person, either the one that contributed the asset to the trust, the trustee, then make sure they are aware of the filing obligation and what is required information so they could act on those issues earlier. Like Paula mentioned, we are already in the January 16th and the return is due on April 2nd. It gives a little bit more than 2 months for you to prepare all this.
And I can think of an example there too, Philip, if I can just interrupt for a second. Even as a tax professional, if you're preparing tax returns, a lot of information slips will say in trust for John Doe. So that's a red flag for you now to know, say, okay, this is most likely a bare trust that may need a filing requirement if it's an account setup, like Philip described earlier.
Yeah, well, kind of continuing with that discussion, a lot of time as tax professionals, we see a lot of joint accounts between spouses. But a lot of time that we would ask the question, well, we should ask the question that does both party contributed equally to those accounts? Is it one just basically on title without any contribution to the asset? So that's some of the question that you should ask. And in case you do identify any of potential issues, initiate the conversation, even go through the requirements, and then discuss further. At least your client or your related party would know about it. Last but not least, in case that you are aware of the trust, and you have a trust, and then you are aware of the reporting requirement, and you want to rely on the $50,000 exception, you would have to keep monitoring it, the value of the asset, and make sure that nothing other than cash and marketable security that is going to be held inside of the trust. That takes a lot of time because sometimes stock market could be wild, and you could get 100% increase in one day, and then by the end of the year, you drop back to 50%. So that for $50,000 exception is throughout the tax year. So it does require a lot of attentions. So those are the tips and reminders. So now we're gonna stay for questions. Before we answer any questions, just another reminder to complete our survey, which you should receive shortly after the webinar in terms of how we can improve and some other topic that you would like us to cover. So now we will stay for questions.
Thank you, Philip and Paula. This is a really interesting topic. We have lots of questions. So the first questions, many bear trust corp won't have a trust deed agreement. So how do we identify a settler if there wasn't initially?
So, I think I would probably go back to how the bear trust was set up originally. In a bear trust, like you have mentioned in the question, you don't necessarily have the seller or beneficiary per se. Usually, it's an agent got appointed to be the bear trustee and holding title on behalf of the beneficiary. So whoever the beneficial owner of the property likely would be the reportable entity. So there would be no separate seller. The beneficiary is basically the one settle or set up the bear trust. So they would be the reportable entity as either the seller or the beneficiary.
Okay, thank you. The next question is, what if a beneficiary refuses to provide you with all the information, such as address, social insurance number, or others? Who is liable, trustee or tax preparer or others? If not available, if the information is not available, what should they do?
I think CRA thought about it already. They allow that, they're saying that in the case that the trustee already trying reasonable effort of gathering the information, but could not get it, either by the beneficiary not willing to share the information, they could write a summary in terms of documenting how much they have tried, but they kind of provide the facts or the information as much as they can. For example, let's say that particular beneficiary, at least you know the name, the relationship, then you could say it, and then also document the fact that they refuse to provide those information required on Schedule 15. Then CRA would usually accept that the trustee already exercised reasonable effort to gather those informations. Because like we have kept emphasizing that in the new reporting requirement, it does ask for a lot of information. A lot of entity would be reportable entity that is rather tough to get all the information, especially for the first years.
Yeah, and like it wouldn't be considered gross negligence if the trustee has made an effort and to get the information. It's more gross negligence, I believe, if they say, okay, I know I'm required to file that, but I'm not going to bother. So as long as you can document your efforts, I think you'd be.
So I mean, go back, kind of summarize to your question is, as long as the trustee exercise reasonable effort and try to get the information, that's good enough.
Okay, I see. Yeah, thank you. I think a lot of our audience has these questions. They may not have all the information, so they just need to provide enough document to prove that.
Yeah, the key is really try to good enough effort, right? It's not like, hey, I know I have 15 beneficiary. They are likely not going to talk to me, and then I just document it. You would have demonstrated you actually try to get the information, have a reasonable amount of effort, maybe try to phone them, email them to get the information, but without success. That's there was some kind of subjectivity in terms of what is reasonable enough. So depending on the risk factors, then you would want to maybe do extra or less, depending on how much you want to, how much risk you want to take.
Okay, thank you. So the next question is a non-resident, for example, less than 100 days in Canada, trust holder receive T3 rentals, US apartment income required to file trust return or not?
Yeah, I don't think the question have enough facts. You said it's a non-resident receiving a T3?
I think it's non-residents receive T3 and under the trust has a rental property.
Okay. So I think the fact that as long as you mentioned that it has a T3, then I assume there was already a Canadian trust already been put in place. then that particular trust would require file a trust return. And that non-resident, by receiving a T3 means it's a beneficiary, it would be a reportable entity. And his or her information should be disclosed on Schedule 15. I hope it answered the question.
That's
Sounds like the trust return's been filed if they're getting a T3.
Yeah, in this case, maybe we need more information. Yeah. Okay. The next question is, foreign residents beneficiary, how to obtain the Canadian tax identification number to file the trust return or not?
So we haven't kind of touched on how to apply for the individual tax numbers. For Canadian tax purpose, if it's required to be disclosed, there was a form for the taxpayer, the non-resident taxpayer, to apply for it. And usually a professional in Canada need to certify certain identification document of that taxpayer, usually a passport or driver license, that it could be submitted together with the individual tax number application. That's how the application process usually goes.
Okay. The next question is, bear trust only for land and buildings?
No, I think in the example we mentioned about that, hey, bear trust could exist way more broadly than we have imagined. Land and building are one of the common use of bear trust, but we mentioned a few times that even in trust account is already a bear trust. So it's really a low bar for bear trust. I think the question really goes back to if the account holder or the title holder really owning the title on behalf of someone else. It doesn't enjoy any of the economical benefit. You're basically holding on behalf of somebody else. That's likely a bear trust.
Okay, let's see. So how about people on the title of the property for the purpose of obtaining a mortgage? Can they use in the bear trust credit?
That question is likely yes. We have that example for our one particular client that just recently moved to Canada, does not have any credit record, that he would ask one of his friends to be the title holder or maybe co-signer of the mortgage. So technically his friend's on title of that property, but all the money is coming from our client. In our conclusion, his friend is basically being a bear trustee on behalf of our client, because he really owns the title, but doesn't own any of the economical interest of the property. That apply to a co-owner or co-title holder for a real property for mortgage purpose.
Okay, thank you. Next questions. A lot of people ask about the settler. So if the settler is a deceased individual, are their personal information still required to report?
Good question. I would think that if you are aware that the settler has been deceased, it doesn't hurt for you to still disclose it, saying that the deceased as of certain day or has been deceased. I think it goes back to the reasonable effort. I'm not sure whether CRE would specifically exclude someone that has been deceased. The settler is always the settler of the trust. But I think for the trustee, for the sake of being more conservative, it's always good to disclose more information than the absolutely minimum.
Yeah, I haven't come across any exclusions for that.
Okay, I see. Yeah, thank you. We have another question is, does being a power of attorney on someone's bank or investment account constitute a bear trust?
Yeah, I think for power of attorney is slightly different than the bear trust. Based on my understanding, I think this is a more legal question than tax question. Is I believe whoever having the power of attorney is not on title of the property that is for the ink subject. So they're mostly making decision on behalf of the other person, but they do not own the property or does not have the title of the other property. So that's different than a bear trust arrangement. I think that the quick answer is no, but obviously more facts have to be collected to make that determination. I think that's it for our question time. Some of the questions we may not have addressed it.
Yes, we still have lots of questions. But yeah, they can reach off any one of us and we can discuss later.
Okay, so thank you for attending our webinar today. So here is our upcoming webinar for our business tax series, the Canadian Assist and Sales Consideration for U.S. Business. You can scan the QR code to get the presenter information and a bit more information about the topic. Again, thank you for attending. Looking forward to seeing you in the future.
Thank you.
Thank you.